Today's topic is, how does stop-loss insurance work? So for those of you that don't know, stop-loss insurance is what employers purchase to mitigate the risk of high-cost claimants. I like to think of it like a fully insured policy for your large claims. So here's how it works. First, there's two types of stop-loss insurance: specific and aggregate. I like to think in worst-case scenarios. So specific stop-loss insurance sets a worst-case scenario for what an employer would have to pay in claims for every individual on the health plan in a given 12-month period. Every individual means every employee, every spouse, and every single child on the health plan. So let's say my employer picked a specific deductible or threshold of $50,000. What that means for them is that they're responsible for the first $50,000 of every individual's claims on the health plan. So if I had $75,000 in claims, or I had $1 million in claims in a 12-month period, my employer only pays $50,000. And if I had $1,000 in claims in a 12-month period, my employer would only pay $1,000. The stop-loss insurance picks up the rest if it's over $50,000, and they don't pick up anything if it's under $50,000. But $50,000 is the worst-case scenario an employer would pay for that individual in that given 12-month period. Aggregate stop-loss coverage sets a worst-case scenario for the aggregate of all of the individual claims in a 12-month period up to that specific deductible amount. The stop-loss carrier really dictates, more so underwrites, what the worst-case scenario is based on the data that they have. They use the data they have to predict what they expect the employer to pay out in that 12-month period, and then they add 25% on top of that expected amount to set that worst case scenario. So let's say they expect an employer to pay out $1 million in claims for a 12-month period. Basically, the worst case scenario is 25% higher than that, or $1.25 million. So let's say my employer is expected to pay out $1 million in claims, but they have $1.5 million in claims for that 12-month period. Well, at the end of the year, they'll get a reimbursement from the stop-loss carrier of $250,000 because they're over the worst-case scenario by that amount. But let's say at the end of the 12-month period, they only have $1.2 million in claims. They're not going to get any reimbursement in that case because they're under the worst-case scenario. For most employers, stop-loss insurance is what makes self-funding a feasible option for them. And if you have an interest in self-funding, I have one piece of advice, which is make sure that you are consulting with a self-funded expert when it comes to stop-loss insurance, because the success of your health plan will depend on it.